You've got your policy. You're excited to get started. You've got all these great ideas on what you want to do with it. But that's not what we're going to be talking about today. Today, what we're going to be talking about is the 3 worst things that you can be doing with your policy. We're going to be sharing with you some of the mistakes that we have seen clients make over the years. And if we're honest, we're going to be sharing some of the mistakes that we have made, right, with our own policies over the years so that you guys don't have to make those. And as is typical around here, Anthony and I do not agree on what the top 3 are, so we actually have our own list.
So really, we're doing the top 6. You're doing 6 through 4, and I'm doing the top 3.
Yeah.
You guys can decide what's the worst.
We're going to be sharing our own 3. Mine are going to be correct. Anthony will fill in the gaps. But hope you guys stick around and enjoy this episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Today, we're talking to you guys about the 3 worst things that you can do with your IBC policy. But first, Anthony, tell them about our live stream coming up.
Well, I mean, if you've got some questions about infinite banking, or if this is for you, one way is to get on a discovery call with us, but maybe that's kind of too much of a commitment.
Very intimidating.
You're right.
Yeah.
So Cameron has such great hair, that will come through the phone line.
First phone call is no video. No video. Just phone call.
Another way to do that is we are doing a live stream once a month, and it's going to be the 3rd Thursday of each month at noon Pacific. Cameron and I will be sharing any updates, any new things going on with infinite banking and ways to create passive income. But there's also an opportunity for you guys to ask us questions. So you can just go on there live and ask them. And if you can't make it, DM us or email us at info@infinitewealthcourse.com, and we will answer your question live. And I also want to give a little shout out to Maddie for...
What did Maddie have to say?
Maddie put a review on our podcast saying this podcast is excellent resource for anyone looking to achieve financial freedom. Super informative and insightful. Maddie, thank you for taking the time to put that down.
Thanks, Maddie. Awesome. Well, let's get back into the meat of this podcast, right? Is we've got our own 3, right? You and I never agree. So we've got our own. We're going to be sharing those. Anthony, how about you kick us off? What's the first one? First, are your 3 in priority, right? Is the number 1 the worst mistake, or is it random?
I think the one is probably the worst.
Okay.
And the most common.
Okay. All right. Perfect. Share us. Why don't you share with our listeners what's your number 1 biggest mistake that somebody can do with their IBC policy?
Well, if you read Becoming Your Own Banker, Nelson calls it stealing the peas.
Ooh.
And if you haven't read the book, you should, okay? And in there, he has a great example of a grocery store, right? And if you had your own store, where would you shop for peas? Somebody else's store or your own? I mean, hopefully you're going to shop at your own. Mm-hmm. But then what his question was, okay, you buy that can of peas. Do you go out the front door and pay for it, or the back door and steal it, right? And a lot of times we're tempted. It's our store. We're just going to scoot out the back door. Mm-hmm. But as Nelson talks about in the book, and we have the calculators to prove it, paying cash has a cost, right? And so if we're going to become our own banker, we need to be an honest banker. So if you take a can of peas off the shelf, you need to pay it back or pay for them. And the analogy, if you haven't figured it out, Cameron, your policy is a grocery store, and the can of peas are your dollars. So if you take $1, you need to pay it back plus interest. And
thank you for that.
I think what is so great about taking a policy loan? It's very easy, and they're not going to bother you.
Yeah.
Right. If you don't pay it back, they're not going to run your credit. They're not going to send you dirty letters or phone calls. It's kind of you're just doing your own thing, and so you need to be responsible.
Yeah.
And it can be very tempting to take that loan and not pay it back. And the downside of that is really the policy. We're going to hinder that policy if we're not paying back the policy. There's going to be that drag on that interest. And to me, what I've seen is people have taken max loans out for an opportunity, and sometimes that opportunity just doesn't work out like they had planned. And the problem gets to be is when the next premium is due, they don't have the cash.
Yeah.
And one of the beauty of of our design is there's going to be cash value that can only be used to invest, which is what we prefer. But if you're in a bind, it can be used to pay the premium.
Mm-hmm.
But you can only use it if it's there. So not only are we hindering, I think, the growth of the policy, but we're jeopardizing the policy itself, because if we're unable to pay the premiums, the policy could lapse.
Well said.
Okay.
Well said. Now I'm regretting having you go first.
Okay.
Yeah.
Which you should have, but no. I thought you were going to go first, but go ahead.
I've got the same one, literally, right? I agree, unfortunately, with you that I think the single worst thing that somebody can do with infinite banking is not paying back your loans. I've been guilty of this over the years, right? When I first started, I'd take money out of the policy, and I really wouldn't kind of set up any sort of repayment schedule. It was just, hey, when I had extra money, and then you go a few years, and you're like, wait a second, I got a pretty good loan on this thing, right? So then you got to kick it into overdrive, start getting aggressive, and start paying those things back. And so that is probably the single greatest way that you can kind of ruin this whole system, is just to continue to take money out without actually replenishing it. And I got to give Nelson some credit again, right? Is if you go back in the book, he's got a great section on assigning your dollar's value. Meaning that I think that a lot of people, that idea of not repaying yourself just comes from the idea that people don't assign value to their own money, right? If you go down to the bank, right, your local bank for a loan, a car loan, an investment loan, business loan, whatever it is they're going to charge you an interest rate. But a lot of times people will access their own money and they don't charge themselves an interest rate. They don't see or assign value to their own dollars. That idea is called economic value added. Nelson introduces us to that concept in his book. We have a great article on it. I will make sure that we put a link into it in the show notes, or email us. We'll get it to you. But if you take 5 minutes and read the article that he references in that book, completely change the way that you look at and value your own money. So great place to start. I wrote down, this is not IBC. This is called stealing the peas, right? So great point. The other thing I'll say is if you've been practicing IBC for a little bit and maybe you find yourself in that position where maybe we've taken some loans and we haven't paid anything back yet, give us a call, right? We're happy to help you kind of set up some sort of loan repayment schedule, set up a loan amortization schedule, whatever you need to get you guys back on the right track.
Great, Cameron. And as we're being full disclosure, I've stolen the peas multiple times, right? And at the very beginning, similar to what you talked about, my first policy, I took out a loan immediately, and I paid off my car note. Okay, and so the plan was, well, instead of paying Ford Credit, or just pay the Faso Family Bank, but I didn't. Right? There was no invoice, there was no phone call, there was no outside pressure of a third party to do it. So to be honest, I didn't. And the problem is, then that cash started to accumulate. Well, like in theory, I should have cash each month, right? But you know what? I didn't.
You didn't pay back.
Not only did I not pay it back, but then I don't know what happened to it. Okay,
It walked away.
It's just I got spent.
Yeah.
You know, a lot of people, and I think a lot of business owners, entrepreneurs, they kind of judge what their spending is by the balance of their checking account.
Yeah.
Had more money, so I spent more money.
Yep.
Right, and then I realized, man, I'm still in the peas, and what I realized is, because part of my concern is I didn't want to give up control of the money. I had a business, and you wanted that liquidity, so I thought I should hold on to it. But when I did that, I actually did the opposite. I actually spent it. But when I realized that once I make that repayment to my policy, it's still liquid.
Yeah.
I can use it and do whatever I want with it. So it took me a few months, and that's why it's important to be working with somebody with a good IBC coach to kind of to set those rails and give you some guidance. And also, I did something maybe even worse than still in the P's. I wasn't even paying premiums. Right? When when we first started this firm, a couple things happened. Right? For one, expenses went up, and to be honest, the income went down. So all of the money that I had was used to invest in this business, so I didn't pay the premiums. But you know what? But eventually I did. And it was a great thing about infinite banking. I didn't have the ability or the cash flow to pay those premiums at that time, but I knew I eventually would. And then once we got back on the ground, our expenses went down and income went back up. Then I started paying premiums going forward. And then eventually I started chipping away at the premiums that I missed. But you know what the beauty part is? My cash value continued to grow this whole time.
Yeah.
My cash value now is the same as if I would have paid those premiums or if I took a loan and paid them off later. So not only did I have that flexibility when times were lean, now at the current time, I'm in the same spot.
Yeah.
Okay.
Great point. If you haven't had a lean year or two, you're not a real entrepreneur. Right? Awesome. So first one, we were actually in agreement on that, is not repaying your loans. We have touched on that many times before, but hopefully we put the final nail in the coffin on that one. Anthony, number 2, the second biggest mistake that you think that somebody can make with their IBC policy. What is it?
I've kind of seen yours. I've been looking over there, and I
cheating.
think it'd be best if you do yours first.
Okay. Awesome.
Not because I'm just going to do a killer and out explain you again, but I think ours kind of relate, but they're kind of the opposite. So
Yeah, so mine's better. So number
they
2.
will decide.
Yeah, number 2, the biggest mistake that I think a lot of people can make, and where I'm coming from is I'm looking at somebody that's just getting introduced to IBC, and so that's what I'm approaching this as. Number 2 is starting off with too big of a policy, right? Is I just had a phone call with a gentleman, right, that had engaged with somebody else in regards to IBC and wanting to learn how to put this stuff to work. He called him up. The guy told him, right, how much he should put into a policy. Number 1.
So the agent told him what
the agent told him what he should be putting in.
Okay.
The guy was like, okay, yeah, I could see that. So they kind of start underwriting. Long story short, he calls the guy back and is like, you know what, I'm not really comfortable at that number. And the guy was adamant about it, and he said he absolutely needs to do it. He would not let him get off of that number for whatever reason. I don't know why, right? So he's uncomfortable. He reaches out to us, and I'm like, man, I'm happy to kind of look at your scenario. I'll give you some suggestions, and that's exactly what we did. We went through it. We had a good conversation on funding, his income, right, what it is now, what he thinks it's going to be over the next couple of years. And you know what? I did give him a suggestion on what it would be, and it was actually half of what the other gentleman told him. The reason I told him half is when you first get introduced to IBC, this is kind of the trajectory that I see a lot. A lot of people get really excited about IBC. And that's great, but there's also got to be some skepticism that comes in. And I think that oftentimes, if you don't start with skepticism, like you'll visit it at some point. And so, right, if somebody gets really excited, is typically I'm telling them to, hey, let's dial back the premiums a little bit and let's start wherever we are, somewhere that's really comfortable for you. And the reason for that is, we talked about before, I think the 2 ways that somebody can kind of ruin IBC, number 1 is stealing the P's, and then number 2 is getting into premiums that are too big for themselves. And the reason for that is because if you get into this and you start writing premium checks that actually feel like more of a burden, that completely changes your feelings on this program, your spouse's feelings on this program. And so it's much easier. We're going to have a much better success rate with someone is if we're coaching them and teaching them how to do this, if we start small and then we build up from there. And so that's kind of been my perspective. The way that I usually communicate that with someone is I hate giving them a number. I really don't like giving somebody a number on what they should put into a policy. But typically the way that I'll present it is I'll say, hey, listen, we're talking about putting X number of premiums in a month. If you were to write a check for that amount at the beginning of every single month, would you think about that? Right? So if it's $1,000 and you needed to write a check at the beginning of every month for $1,000, if you can write that and not think about it, great, we're in the ballpark. If you're going to write that check and you're going to think about it like, man, I hope everything goes well this month, I might need that back, we're way too high, right? So that's usually kind of the metric that we'll use, kind of the intangible metric that we'll use when trying to figure out premiums. So that's kind of what I got.
Okay, I've gotten people saying where, they've read the book, super excited, want to put in, let's just say $1,000 a month because that's what you would use. Great, but how much are you saving now? And they're like, well, I haven't saved anything. Well, if we go from 0 to 1,000, could be setting ourselves up for failure. What I tell people is let's practice. Why don't you take a couple months, put that $1,000 away, and let's see, is that $1,000 too much, or maybe it's too little? But at least once we practice, then we can feel more comfortable about how much to put in the premium.
Great point. That's one of the ways that we will use term insurance, right? Hey, let's put a whole life policy in place for something that's comfortable. We'll take some term, and when we need to or want to increase our premiums at a later date, we'll just take that term and convert it. So, awesome. Anthony, I gave the correct answer of starting with the policy too big. Let's hear your incorrect answer.
Mine, kind of the exact opposite. Now, but this is people in different points of their journey.
Okay.
When you're starting out, start slow, right?
Good advice.
Right, there's gonna be a point, like you're a skeptic. I remember my first policy was teeny.
Yeah.
Right, but I was skeptical. But what I don't want you to do is to maintain that skepticism. Try this out, and you're going to see that it works, just like Nelson said. And at that point, that's when you need to not be afraid to capitalize. So a big mistake I see people making with infinite banking is they're afraid of a larger premium. And again, we got to be skeptical. You got to understand IBC. That's got to be the first process. But once you do that, we have to realize that these premiums, they're not payments, they're deposits.
Great point.
Right? A payment is really a deposit in somebody else's account. Right? A deposit is a deposit in an account that you own and control, and that's what we should be viewing these policies are, as an asset. This is where we're going to store cash, and the bigger that bucket is, the more cash that we can put into it. Oftentimes I see people get turned off on the slow start of infinite banking, right? The first year you put in $1, you're not going to you can't turn around and access that whole $1. So people are a little bit apprehensive of the short term. But when you look at the long term, I mean, this more than pays off. So sometimes if you're scared of that short term, let's also kind of look a more big picture and focus on the end game. And those larger premiums, like, one thing, if you ask people, what regret they had, I would say 80% of the time it's, I started too small.
Yeah.
What I tell people, you didn't. You started where you should.
Yeah,
you started in the right spot. The question is, you want to finish in the right spot.
Yeah. We've got, right, when somebody gets started, we got a lot of time that we can increase premiums.
Yeah.
And is don't ever look back. And I hate that question, if I'm honest, is because, right, you look back and you know so much more now than you did then, right, as you're just getting introduced to this idea, right? We're going to make sure you guys start off somewhere comfortable, right? Cool. Awesome. So I would say, again, I was right on point number 2. Yeah. All right, moving on. Point number 3, right? The third worst thing that you can do to your IBC policy. Anthony, you want to go first?
Yeah, I'll go first.
I'm a gentleman.
Well,
Go ahead.
mine's going to be better. Mine's more worse than yours.
Mine's better. I'm going to wrap it up with a better point.
And honestly, this thing here is probably, this irks me the most.
Works.
With
Ooh.
working people and teaching them about infinite banking.
Okay.
Is that they're not using their policies.
That's a good one.
Right? Yes, you're right.
That's a good one.
And oftentimes people will feel, when they're learning about this, they start the policies building up cash value. And too often I see people, they're hesitant to take a policy loan because they don't want to pay the interest. I get it, but you have to look at the whole picture. There is interest. The reason why there's interest, because we're not using your money. We're using the insurance company's money. We're just using your money as collateral. So there's going to be interest to use somebody else's money, but in return, because we never touch yours, your cash value is going to continue to grow even though you are using it. And a prime example is if you have this cash value, and let's just say at a certain point in time, the cash value is going to be projected to be $100,000. Okay, I'm gonna need your help with this.
Okay, I need to write numbers down.
Okay, so let's say, Cameron, we take a policy loan, say year 1 or 2.
Yep.
Buy an asset. We use the cash flow from that asset to pay back the policy loan. Let's say a rental property. So the down payment comes from a policy loan. We take the cash value from the rental income, repay that loan. Let's say we repay that loan in year 10, where the illustration says we have $100,000. Now, to be fair, that projection is based on the dividend. So let's just assume that dividends stay the same. Okay. So if it says we should have $100,000 in that year, Cameron, we borrow money and pay it back, how much should we have?
We should have 100,000.
How come?
Because it doesn't matter if you use it or not.
Because we never touch that money.
Mm-hmm.
Your money is still there in the policy. We just use it as collateral. So if you use a policy, you're still going to have 110. You're going to have 100,000 in there whether you use it or not. But if you use it, you now have a cash flowing asset that has at least a down payment in equity. And that's not taken into account any appreciation over that time and or any of the principal that was paid down.
Yep.
So to me, the worst thing you can do with a policy, well, for one, I think the worst is still in the P's, but the second worst thing is not using it. If you don't use it, you're going to lose it. So beat that, Cameron.
That was pretty good. I'm not going to lie. That's a good one. And you are passionate about this. This guy walks around this office all day, every day, just complaining about people not using the policy.
Yeah.
So, guys, get to work. Go put that stuff to use. My point, thanks for asking, Anthony. My number 3 is going to be when people are borrowing against a policy, there's a few things that you can invest in. And so my gripe or my irk, I guess, is more so directed at some of the advisors in our industry, right? No names, no finger pointing, right? If you call me, I'll tell you who they are. I'm just kidding. But there's a couple of things that you can do with cash, right, or with a policy loan. Number 1 is you can go out there, which is what we talk about nonstop all the time, is, hey, let's go buy cash flowing asset, an appreciating investment, right? Let's go buy a business, something like that. The second thing that you can do that we are less fans of, right, but Anthony and I shared a couple mistakes that we've made, is borrowing against a policy to go finance, right, depreciating assets, or what some people call recapturing expenses, albeit a vehicle, right, or a car. You can do that and you can make money, but that's not the most efficient thing you can do with it. And the third thing that you could do, in my opinion, which is one of the worst things that you can do, is this idea of laddering, right, is when you're borrowing against your cash value to turn around and go buy an additional policy. There are advisors out there that are recommending that people do that. number one, I think it's illegal, right? But number two,
yeah.
right? It is typically is not. I will say not typically. It is not in the best interest of somebody to do that. We've shared a podcast where we've talked about potentially opening up policies in anticipation of windfalls.
Mm-hmm.
That's a different conversation than what I'm having here. So we'll put the link in there so you guys understand the difference. But listen, if somebody is having that or giving that recommendation, in my opinion, it is a huge red flag. And what it is, it's a complete misunderstanding of what IBC is. Mm-hmm. They are viewing that policy as, quote unquote, the investment. So they're trying to make that investment as big as they can get it, but that's not really what it's designed for. It's just a holding account, right? And then we'll go use it for other investments, typically cash flowing. So that's my gripe. I'm not a big fan of it. If you hear somebody talk about laddering, right, feel free to reach out to us. No names.
When I first heard about laddering, I got super excited.
Oh, yeah.
I mean, you look at it from the agent point of view, I can have my clients open up a policy every year as opposed to waiting until their cash grows. I mean, it just sounds great piece for business. But one thing we always say we do here is we do the math. In my excitement, I went, believe it or not, I created a spreadsheet and kind of compared laddering versus non-laddering. And as much as I would love to have all my clients ladder, I don't feel it's in the best interest of them.
Yeah.
And so we don't.
Well said. Anthony, I'm going to share a takeaway.
Oh, what's your takeaway?
Well, I was hoping you would ask, but I'm just going to share.
Okay.
Yeah. My takeaway, right, as
Was
I look...
my 3 or what? Was that your takeaway?
No, my 3 were right. Yours were okay. My takeaway in looking at mine and yours is the mistakes that people will make and the mistakes that I've made, they're all human errors. It's not something that is inherent in the policy that is bad or a mistake. It's how we handle this, right? It's the way that we handle our banking system and the policies that we own, right? Paying stuff back, make sure we pay premiums on time, make sure we don't miss anything, right? It's all of that stuff that is where the mistakes are going to be made. My challenge, right now to you guys and to me as I look back at this is the challenge I'm going to put down to you guys that I'm going to put to myself as well is to get back to the fundamentals, right? Unfortunately, I've not read Nelson's book in a little bit. I would say, if I'm honest, probably a couple years. When I first got into IBC, man, I read that thing like once a month, right? Super excited about it. I digested all the information. I used to be able to kind of cite the words in the book on certain pages, right? And I love that thing, and I've gotten away from it. And so right now, when we're faced with kind of times of uncertainty, it's my belief that we need to get back to the fundamentals. I'm going to go back and dedicate myself to kind of getting back to what Nelson said in the book. I'm going to be reading Nelson's book in the next 2 weeks, and I hope you guys will join me just to kind of refresh ourselves and get back to some of the fundamentals.
That's awesome.
Yeah.
Now, if you can do that 5 times, Cameron, then you will have read the book the same amount of time as me. But I'm going to read it twice during the next 2 weeks. Okay?
You're an idiot.
I know.
Awesome. All right, let's wrap this thing up, guys. We just shared with you our own 3 worst things that you can do with an IBC policy. We had a little bit of overlap, right? We're passionate about some of the mistakes that we don't want you guys to make along the way, and so we're happy to share some of ours with you guys. That way you guys don't do it. But let's wrap it up, Anthony.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.